I want you to try and imagine something for a second. Just really picture yourself watching exactly $428,435,000 just evaporate into thin air.
Yeah, just gone.
Right. Completely gone. And not over like a grinding year-long bear market or even over a month.
Oh, no.
No, in exactly 72 hours. Just a complete devastating flatline that leaves this highly active digital community staring at entirely worthless portfolios.
It is genuinely hard to wrap your head around that kind of financial velocity.
Yeah.
I mean, the sheer speed of destruction in these systems can be breathtaking.
It really is. And, normally when we see a crypto ecosystem die that violently and that fast, we all know the standard script.
Right, that a rug pull.
Exactly, a rug pull. The developers drain whatever liquidity is left, vanish into the digital ether, and just leave everyone holding empty bags. But today, we're looking at something so entirely counterintuitive, it almost sounds like a punchline.
It really does.
So, welcome back to this deep dive. Our mission today is to unpack a mechanism that flips that entire rug pull script completely upside down. We are examining what is being called a rug rollout.
Which is just a fascinating concept right on its face.
Yeah.
I mean, if a rug pull is ripping the floor out from under a community, a rug rollout is an active attempt to pour a new concrete foundation under a house that's already collapsed.
Yeah, like trying to uncrash a car.
Exactly. Instead of extracting value and disappearing, we are analyzing a scenario where an entirely new group of owners steps in. They're trying to execute this highly orchestrated rescue mission to inject massive value back into a dead ledger.
And to figure out how on earth you even engineer a rescue mission like that, we are tearing into an incredibly detailed primary source today.
It's quite the document.
It really is. It's a presentation deck dated March 31st, 2026, and it's titled The Unity NFT Community Giveaway. But before we get into the actual nuts and bolts of how you reverse engineer a collapsed market, I need to set some very strict ground rules for you listening.
Yeah, this is crucial.
Because this source document contains some highly contentious, heavily politically charged legal claims involving the Securities and Exchange Commission.
Very aggressive, highly specific claims against regulators, actually.
Right, so we need to be crystal clear up front. In this deep dive, we are neutrally reporting the historical narrative exactly as it is presented by the authors of the strategy document.
Completely neutral.
We are not taking sides, we are not endorsing any political or regulatory viewpoints, and we are absolutely not confirming the legal validity of these claims. We are just simply examining the blueprint of the strategy exactly as it appears on the page.
And, to understand the mechanics of this strategy, to really grasp why this rug rollout was even deemed necessary in the first place, we have to first dissect the crash itself.
Makes sense.
Because you can't understand the architecture of the rescue without understanding the physics of the collapse.
So let's take you back to August of 2023. At that time, this ecosystem was managed by a parent company called DLI, and their main offering revolved around selling Node software licenses.
Right, people were buying these, plugging into the network, and earning yields.
Yeah, exactly. And everything is functioning normally until August 3rd. That is when the SEC obtains a temporary restraining order against the DLI platform. They step in and classify these specific Node licenses not as software, but as unregistered securities.
They eventually argued these were investment contracts.
And the market reaction to that regulatory filing wasn't just like a slight downturn. It was an absolute unmitigated panic.
Oh, completely.
Yeah.
Looking at DLI's internal numbers from the deck, it maps out like a geological fault line just completely giving way.
Wow.
Yet within roughly 72 hours of the SEC press release hitting the wires, the resulting sell-off triggered an uncontrolled liquidity drain. 71% of the platform's entire market cap was wiped out.
71%.
In 3 days. That is where that $428 million evaporation comes from. 7 legacy projects within the DLI ecosystem just instantly defaulted.
But wait, I want to pause on that 72-hour window for a second, because if I'm holding a traditional stock and the company gets raided or hit with a massive lawsuit, trading halts, right?
Yeah, exactly, yeah.
So why didn't anyone just pull the plug on the smart contracts to stop the bleed?
Well, because you literally can't. And that is the fundamental structural fragility of crypto markets.
Right.
Traditional markets have built-in circuit breakers. Exchanges halt trading during catastrophic news to let the market digest the information rationally. Decentralized automated market makers, or AMMs, they don't have circuit breakers.
They just keep going.
They operate 24/7, based purely on code.
So it's basically like an algorithmic bank run where the vault doors are coded to stay open forever and the vault actually shrinks the faster people run out.
That's a great way to put it.
Because there's no traditional order book, right? So when that SEC news drops, it's like someone yelling fire in a crowded theater, but there are literally no fire exits.
None at all.
The AMM algorithm just keeps repricing the token downward against the rapidly draining liquidity. It essentially accelerates the destruction as everyone rushes for the same shrinking exit door.
Precisely. The underlying math of the protocol could be completely sound, but when human psychology breaks under regulatory shock, the AMM mathematically enforces that panic all the way down to zero.
Wow.
And because the collapse was driven by that external shock rather than, say, a flaw in the actual code, the source document spends a significant amount of time mounting a ferocious defense against the intervention itself.
Oh, ferocious is definitely the right word. DLI's defense in this material is incredibly pointed. They explicitly claim that the SEC's temporary restraining order was illegally obtained.
They don't hold back.
No, they don't. They specifically name the Salt Lake City Regional Office citing regulators Michael Welsh and Casey Frock and claim that their stated need to protect investors was entirely falsified.
And they build this defense on a few core pillars. First is the jurisdictional argument. The documentation highlights that DLI's corporate operations had formally moved outside the United States in May of 2023.
Which is months before the August intervention.
Right, so they are arguing there was no ongoing offering happening within U.S. borders at all, rendering the SEC's move invalid.
But, the argument that really stands out to me is the harm argument. They aren't just saying the SEC overstepped its jurisdiction.
No, they go much further.
They're explicitly claiming that the SEC caused the exact disaster they were supposedly trying to prevent. And the deck includes actual screenshots of individual lawsuits to back this up.
It's pretty striking to see on the page.
Yeah, like one specific user documented a loss of $475,979. Another lost $140,000. And the claim is that those catastrophic personal losses were due entirely to the speculative panic sparked by the SEC's press release.
Not the protocol itself. It is a devastating accusation from a systems perspective. They are arguing that before the regulator spoke, the community and the AMM pools were whole. After the regulator spoke, the community was destroyed.
They're essentially framing the regulators as a doctor who accidentally stops a patient's heart while aggressively trying to take their pulse.
That's exactly it.
Like the patient was walking and talking just fine, but the intervention itself was fatal. And that leaves us with a graveyard. DLI defaults. Those 7 legacy projects, which, by the way, were branded around tangible, real-world commodities like oil derricks, corn, data servers, and excavators, they all just die.
Which perfectly sets the stage for the rug rollout.
And this is where my brain just hits a wall. Because, okay, here's where it gets really interesting. If I'm looking at this from a cynical business perspective, I have to ask, why on earth would a new group of developers voluntarily step into this radioactive war zone?
Right. Why take it on?
Logically, those projects are dead forever. Wouldn't it be infinitely cleaner and vastly easier to just take the underlying technology, fork it, rebrand it, and build a brand new community from scratch?
It definitely seems that way.
I mean, why take on the massive liability of thousands of angry, traumatized users who just watched $500,000 evaporate?
Well, if you look at it strictly as a technology play, yes, forking is easier. But that ignores the brutal customer acquisition costs in the Web3 space today.
Oh, okay.
Getting a new user to notice your project, trust your smart contracts, bridge their assets, and provide liquidity, it is incredibly expensive.
Right.
It's vastly harder than Web2 customer acquisition. You're constantly fighting through immense noise and skepticism.
Because you're saying this grand rescue mission isn't some act of pure, unadulterated altruism.
Oh, not at all. It is a brilliant, highly calculated, strategic acquisition. Imagine you're holding one of those wallets. You've been battered, you feel abandoned by the previous management, and you're furious at the regulators. If a new ownership group steps in and makes you whole, they are instantly buying fierce, unshakable loyalty.
Wow, so they're turning victims into a pre-assembled, emotionally invested growth engine for their future projects.
Exactly. You don't have to spend millions on marketing if you can salvage a community that already knows how to use your tech stack.
That is wild. But wait, what about the timing of this rescue? Because it's highly specific. Why launch this rug rollout in early 2026 and not, say, the day after the crash in 2023?
The document points to a critical regulatory shift that actually makes this legally viable.
Oh, really?
Yes. It references joint guidance from the SEC and the CFTC dated March 18, 2026.
Okay.
That guidance explicitly defined airdrops, which is the act of distributing digital assets directly to user wallets for free as non-securities.
Oh.
So the regulators themselves actually paved a safe path for this new ownership to execute this loyalty play without triggering the exact same traps that destroyed DLI.
That is a crazy twist. Okay, let's unpack the actual mechanics of this then. Because a grand rescue operation sounds amazing on a slick PDF, but executing it on a shattered, chaotic blockchain is a totally different reality.
It's an operational nightmare.
Right. Everyone was panic selling for 72 straight hours. Wallets were dumping tokens into AMMs. Bots were arbitraging the collapse. How do you establish undeniable physical proof of who actually owned what before the chaos?
Well, you utilize a forensic mechanism called a freeze frame.
A freeze frame.
Yeah. The new owners established a strict on-chain timestamp, specifically August 2nd, 2023.
Which is the exact day before the SEC announcement.
Exactly, before the subsequent market crash.
I love this concept. It's exactly like finding a high-resolution security photo of a bank vault taken exactly 5 minutes before a massive heist.
Right.
And you use that specific photograph to prove exactly what belongs to whom, completely ignoring the fact that the vault sitting in front of you today is just totally empty.
That is precisely the mechanism. And the strategy deck uses the black gold project ticker, BGLD, which represented digital oil assets, as the main test case for this rollout.
Okay, so how does it work for the users?
If your wallet held a BGLD NFT on that August 2nd freeze frame, you are eligible to receive a newly minted Unity NFT, or UNFT.
But wait, if you're listening to this and doing the math in your head, you've probably realized a massive discrepancy here.
Oh, absolutely.
Because users originally bought into these BGLD NFTs at vastly different price points, right? The entry floor was around $2,000, but the highest price someone paid for a premium tier was like $48,000.
Yes, huge variance.
So how does a smart contract accurately refund thousands of highly variable historical purchases?
It doesn't. It doesn't even try.
Wait, really?
Tracing every single dynamic secondary trade and refunding exact historical purchase amounts across thousands of anonymous wallets is computationally prohibitive. It might even be impossible.
So what did they do?
The new owners applied a blunt median average. They set the value of every single replacement Unity NFT at exactly $26,000.
Oh, wow. Which is absolutely brutal if you think about it.
It is what I call ruthless utilitarianism. They deliberately sacrifice perfect individual fairness for systemic functionality. Because just think about the wealth transfer happening with that $26,000 flat rate.
Seriously, the person who paid $48,000 at the top of the market is taking a massive, painful haircut.
Oh yeah, they're losing almost half.
But the person who bought in at the ground floor for $2,000 is suddenly looking at a massive windfall. It's like the new owners drawing a line in the sand and saying, the rule is simple, take the $26,000 UNFT or take nothing.
Yep. And that solves the restitution for the NFT holders. But what about the retail users who didn't own the NFTs, but were just holding the liquid BGLD tokens on the open market?
Right, because there were tokens too, not just NFTs.
Exactly. The document outlines a highly complex token bridge to solve this. On that August 2nd freeze frame, one single BGLD token was worth a fraction of a penny, specifically $0.0003191.
So wait. To equal the buying power of one $26,000 UNFT, you would need an astronomical amount of those tokens.
Very astronomical.
The exact number here is wild. Let me look. You need exactly 81,479,160.13 tokens to qualify for one UNFT.
You need 81.4 million tokens just to get back to the starting line of a single NFT.
Which is insane. I'm looking at these numbers, and most retail users didn't hold anywhere near 80 million tokens. So what happens to the user with, I don't know, only 10 million tokens? Are they just zeroed out? Is the contract just leaving them behind?
Not zeroed out, but they are pushed into a secondary fractional pool.
Okay, how does that work?
Well, from a coding perspective, it's a total nightmare to execute. The smart contract has to read that historical August 2nd snapshot, aggregate all the non-qualifying balances, the 10 millions, the 5 millions, calculate the total secondary UNFT allocation for that entire pool, and then distribute claims on a pro rata basis.
Wow, okay.
So you get a much smaller payout based purely on your percentage of that aggregated pool.
It is highly calculated, it is incredibly ruthless, but it physically creates a path forward.
It does.
But honestly, this is where I start hitting a wall with the source material again. Let's unpack this for a second, because math on a ledger is just numbers.
Sure.
You can write a smart contract that says a newly minted Unity NFT is worth $26,000. You can bridge all the tokens you want, but you can't just code actual real-world value into existence. Where is the tangible fiat coming from to actually back these millions of dollars in UNFTs?
This is the absolute crux of the entire document. This is where the digital rescue takes a hard, sudden pivot into the physical world. The presentation reveals that this entire system relies on real-world assets, or RWA. Specifically, the UNFTs earn what are called oil well rewards.
Wait, hold on. From actual physical oil?
Yes, from physical African oil wells that are slated to be drilled. The value generated from extracting that physical commodity is processed in roughly 30-day batches.
How does a 30-day physical drilling batch translate into real-time smart contract yields? I mean, how does that even work?
It requires a massive off-chain to on-chain bridge. The physical revenues generated off-chain are cryptographically verified and swapped for stablecoins, specifically Tether or tangibles, which are then injected back into the smart contracts.
Oh, I see.
Yeah, and then those rewards flow to the UNFT holders, allowing them to lock in actual real-world dollar value.
But the fine print on this arrangement is staggering. I mean, DLI, the original creators of the code, completely defaulted. They stepped away and are now just acting as a consultant.
Right, they aren't in charge anymore.
So who is actually running the blockchain operations now? The document openly admits it's the physical operators, the drillers, the farmers, the people physically extracting the commodities are now in charge of the digital restitution.
Which is an unprecedented operational transfer. And the document is incredibly transparent about the risk profile here.
I would hope so.
It explicitly states that these physical operators have, and I quote, very little prior RWA tokenization experience.
Unbelievable.
They know how to drill for oil. They do not know how to code fractional pro rata smart contracts. So they're having to rely entirely on third-party tech partners to make this infrastructure function.
And there are absolutely zero legal guarantees for the users.
None.
The disclaimers clearly state that this entire multi-million-dollar operation is legally framed as a quote-unquote gift. Validation of these assets is at the new owner's sole discretion. There is absolutely no legal obligation for these oil drillers to bail out this digital community.
None whatsoever. And if we step back and look at the history of the space, the irony of this setup is profound.
It really is.
For years, the foundational narrative of crypto was that decentralization, immutable smart contracts, and pristine digital math were going to fix the broken, inefficient, legacy physical world.
Crypto fixes everything. That was the mantra. But here, we have the exact opposite mechanism playing out.
Exactly the opposite.
A highly sophisticated digital ecosystem completely collapsed because of human panic and a regulatory filing. The math couldn't save itself, and the only way to rescue it, literally the only lifeline, is for the operators of physical assets, the people with their boots in the mud extracting actual fossil fuels, to step in and bail out the digital ledger.
The physical world had to rescue the digital one. The ledger is entirely dependent on the drill.
So if you are listening to this, why does any of this matter to you? We've covered a massive, complex journey today. We started with a highly controversial SEC intervention that triggered a $428 million algorithmic bank run in just 72 hours.
Total wipeout.
Yeah, and then we explored an unprecedented rug rollout using an August 2nd freeze frame, navigating brutal $26,000 median averages and 81 million token bridges. And all of that was designed strategically to buy user loyalty.
A brilliant strategy, mechanically speaking.
Truly. And finally, we unpacked a digital restitution plan that is entirely dependent on the physical flow of African oil. Digging into raw, unfiltered strategy decks like this, reading the exact mechanics of disaster recovery, is how you cut through the endless Web3 hype and understand the actual physical mechanics driving this industry.
It definitely forces a massive perspective shift on what actually backs digital value. And I think it leaves us with a critical question to mull over long after we sign off today.
That's it.
Well, if the ultimate lifeline for a sophisticated, trustless, decentralized digital asset is, at the end of the day, the physical extraction of old-school fossil fuels and the purely discretionary hope of human generosity, does that mean a truly independent, trustless digital economy was always an illusion?
Wow. Yeah, if it all eventually comes back to oil in the ground and just trusting the people drilling it, maybe the code was never enough on its own.
Something to think about.
Definitely.
Yeah.
So the next time you hear about a digital asset evaporating into thin air, just remember, sometimes it takes a heavy piece of physical drilling equipment to pull those numbers back down to earth. Thanks for joining us on this deep dive. We'll see you next time.